Just stop it. The run-of-the-mill, cheesy, humdrum bullshit status quo just tires me out. What fascinates me are the industry disruptors, the superhuman frontiersmen or women who go through hell to achieve their goals. Join me as we meet and learn from those mavericks, rebels, and business leaders that aren't afraid to piss off the establishment in order to make radical change for good. Sponsored by Johto PR, the disruptive anti-PR firm that murders your competition with cinder blocks and cyanide. This is Disruption Interruption. Welcome back, everybody, to Disruption Interruption. I'm your host, KJ, and we're here today to talk to another industry leader that has steered off the lame, tired path of the status quo. All right, most people hear the word crypto and they immediately think of meme coins, overnight millionaires, and a whole lot of other boom or bust noise. We've also been told that blockchain is either a total scam or a magic wand that fixes everything. Meanwhile, the venture capital world has its own status quo, telling founders they have to lock up their lives for maybe 10 years to see a dime of liquidity. Our guest today is here to stop the gambling and start the strategy. He's a World Series poker champion, a 5-time founder, and literally wrote the #1 best-selling book on venture capital. He's disrupting the VC status quo by offering founders and early-stage companies something big firms hate. I don't know if they hate it, but offering them liquidity. Through acquisitions, he's proving that Web3 isn't just a digital playground. It's an operating system for the creator economy and global finance. We're diving into why the 10-year VC lockup is in the past, how to read the poker table of global markets, and why the future of finance is about tokenizing the world around us. Please welcome our disruptor, the Chief Strategy Officer of the crypto company, Rafe Furst.
Yay. Awesome. Can I bottle that introduction for the future? That was really great. Very flattering.
You totally can. Yeah. Kudos to the editorial team. They really digest it and figure out how to distill who you are. Okay, Rafe, we got the coolest name. We have the coolest story to talk about today. I'm so interested in it. Before we get going, our listeners always want to find out from the guest, for you, what has driven you personally in your life towards disruptive innovation?
That's a great question. I think as long as I remember, I've always seen and believed in possibilities that most people haven't yet seen or experienced. And I yearn to be able to bring those possibilities into the present. I love play. I love exploration. I love creative thinking outside the box. And when I see, a future that needs to happen, I just go for it. And oftentimes the status quo is in the way of that. And unfortunately, I think that's just human nature and the nature of institutions is that they want to preserve the status quo. And so I'm not ever interested in disrupting. It just so happens that the world I want to live in and play in is sometimes temporarily blocked by forces or institutions or ways of doing things or technologies that block the way.
Yeah, that's a really good answer. Yeah, it's like you have a blank canvas to play from and you are creating this canvas and then it's like, wait a minute, this is in the way. Get it out of the way, right? So speaking of this, it does naturally go against the status quo, right? Mm-hmm. Let's talk about this, because you've had much disruption in your life. But we're today talking about something different for founders and, startups and companies and offering them liquidity. Tell us about the status quo, the good, the bad, the ugly of it, that before we get into the solution that sort of led you towards this path.
Yeah, I'll go back to my first experiences and my journey as a founder.
Good.
And also as an angel investor too, which is, so I was in Silicon Valley. I just graduated from Stanford University, where I'd gotten an advanced degree in artificial intelligence. I was really interested in entrepreneurship. Artificial intelligence was not what it is today, and there wasn't opportunities really there to commercialize AI. I was doing research, and then a friend of mine in the computer science department at Stanford showed me what was the very first web browser. And I had this instant recognition of, oh my God, this is going to change everything. Every business, every individual has to get on this thing called the World Wide Web. And so with a number of friends in Silicon Valley, we started ideating on businesses that we could do together, take advantage of the opportunity, early web companies. It was blue sky everywhere. There was nothing built out. And so we had the fun and also the daunting task of like narrowing down what we were going to focus on to
Yeah, I
launch our
bet.
company.
You had to
And
do a lot of like prediction
yeah,
about,
it was really more about creation. It was that
yeah.
blank canvas. And so we ideated for several months, a group of about 15 of us. What were we going to build? What could we do? What would be fun? What would not take a lot of money because none of us were wealthy, and we didn't have like wealthy relatives. And then we also, at the time, venture capitalists had such a bad reputation as we called them vulture capitalists. And
Oh,
so
okay.
we,
I love names and terms like that, that people have in inside groups. It's like the
yeah,
Infernal Revenue Service, right?
I haven't heard that one.
Okay, well, I haven't heard of vulture capitalists, so there
Okay.
you go.
This
Okay.
was in the late 80s and early 90s. And so we knew that we had to reduce the space of possibilities down to something that we could bootstrap ourselves, right? Just on our sweat equity, and wouldn't take a lot of capital. And the good news
Because you
is,
didn't want the vulture capitalists.
no, we didn't want to take on outside investors
Give
at
me a
all.
little data about why they were called vulture capitalists back then. Like educate our obvious. We have some founders and
Yeah.
startups here, but they may not go back that far, right?
Right. Yeah. It was because, unfortunately, they would, not always, but oftentimes when they disagreed with the direction that the founder was going, or felt like the founder was not doing a good job, they would take control of the company and they would kick the founder out.
And that's typically what private equity does today. How is that any different?
Well, venture capital is a form of private equity,
Yeah, it's true. You're
different
right.
stage.
Yeah.
And so, that was it. We didn't want to lose control. We wanted to and also we weren't in it at that point. We weren't in it to build something that lasted. We were in it to turn the company, or like to flip the company to somebody who could scale it, because
Mm.
we were not seasoned executives. We were not seasoned builders of companies. We
So
were
you had that
technology.
foresight going in. You're
Yeah.
like, let's do this, let's bootstrap it, and then let's turn it over. Okay.
Yeah. Yeah. And that was our goal with that first company. So that's what we did. And it was amazing. We had no idea what we were doing, but we had tailwinds. It was a great time in Silicon Valley. And we got, I think, very fortunate in the timing. We had foresight. We got in early and we were able to sell it, to a larger company in a roll up. And that was an amazing experience. And, I'm very glad for it. And of course, when you do things and it comes easy, you don't really understand what are all the pitfalls and
Right.
and detours that you could have taken. So that was my first experience, and doing it ourselves, not taking outside investors,
And it
uh,
went well.
and it went really well. And so I guess, you asked about like what is the problem with venture capital, or why. I think there's nothing wrong inherently with venture capital. The idea of taking outside investors, many ideas, they require seed capital, they require growth capital. I think of venture capital as seed capital, or ideas, and products and services are transformative, that are disruptive, that you can't do incrementally.
Yeah.
And I think what has happened in the venture capital world is, in the interest of de-risking the investment, they have decided to put most of their money into the later stages. And
Mm.
they really, oftentimes invest in the early stages, not because they necessarily believe wholeheartedly in the team or the founders or the company as it exists, but because they're looking to buy a lottery ticket to be able to deploy capital much later on. And so that's where the problem begins, because I want
The
investors.
consequences of that.
Yeah.
Yeah.
Yeah. I want investors that are aligned and that are backing me and my co-founders. They know that the only way that they're really going to be truly successful is if they help, the founders and the company grow with more than just their capital.
Mm-hmm.
So adding value and really being aligned board members, aligned advisors, and not looking to take control or make changes in the business because they lose faith in the founder.
Well, that's really interesting. You mentioned something here of adding value, right?
Mhm.
What would be some of the things that would really add value and would really help a startup in the beginning?
Yeah. I think it's really spending a lot of time, as an advisor, not as a board level fiduciary. There's a big difference between a board member and an advisor or a friend of the company. And so, the best VCs do play that role, but they also have limited bandwidth because they're working on a big portfolio of companies. And so I think there's probably two ways that VCs could improve. Okay, three ways,
Okay,
right?
number one, 4 ways. Now look
The
at you.
the first way is stick to true venture capital, early stage, not multi-stage, catalyzing investment that won't come from anywhere else, investment that comes with somebody who sees the potential for exponential returns, but realizes that, they're going to just have to accept a lot of losses and a lot of zeros. And I think that the VC industry has become more like private equity
Mm-hmm.
and that they're really looking to de-risk. And the reasons of that are manyfold, and it has to do with the amount of money that's poured into their limited partner structures. They want to get more money under management because that's risk-free management fees. They also get greater carry if they get, something that is 100x and they're not interested in even 10x returns because that's not enough. It's just there's a lot of structural, I would call it perverse incentives or misaligned
Mm-hmm.
incentives between the VCs and founders, as well as the VCs limited partner investors.
It's so interesting that you say that. Leaves such a huge vacuum
Yeah,
for the early stage startups. I look at early stage startups, you talk about the blue sky, you talk about the imagination, you talk about the canvas. I mean, things that are truly changing industries
yeah,
and the world, right? It's almost like a first-time home buyer. It's like
yeah,
first-time home buyer has so much importance to our economy, right? It would be knocking out, an entire sector of companies that have such an importance to the long-term viability of our economy.
yeah, yeah. I mean, so just to close the first point, I think the thing that VCs could do if they really want to be venture capitalists, invest at the early stage possible. Pick your founding team, invest your $1 million or whatever it is, and don't look to make any more investments. Instead, after that, really look not to take board control, just advise the company, advise the founders, be their friends, be their mentors. So that's number one. And then from there, I would say there's probably two optimal strategies if you're thinking of it from the VC standpoint that you could do. One is, like I said, really just a handful of companies and really get in the trenches and work with them. Okay. The other is to do maybe a more quantitative approach, which is, okay, I'm going to invest in hundreds of companies, hundreds of early stage founders a year. And I'm not going to spend a ton of time doing deep diligence. And I'm not going to spend any time after I write that check. I'm really just going to algorithmically allocate to this early stage layer where we know the returns are going to be high.
Mm-hmm.
Okay, so two different approaches. I call that latter approach
One's
game.
qualitative and one's
Yeah,
quantitative, isn't
yeah,
it? Yeah.
qualitative, selective, deeply involved, and the other is quantitative, hands off, at scale, game theory optimal.
Yeah. Yeah.
What I think that the problem with the VC industry right now is it tries to split the baby and have the best of both worlds, and it does a disservice. And frankly, they're underperforming what they should be. One stat that I talk about in my book is that the angel investment market as a whole returns about 30% IRR
Hmm.
consistently over the years. But you have to use the law of large numbers. You have to invest in literally 100 new investments per year for at least a period of 5 years in order to achieve that 30% IRR. 30% IRR is unheard of. Okay. It does better than all the quantitative hedge funds, all the, Warren Buffett, all the best investors. It's unheard of. But venture capitalists actually are much less than 20% because they're splitting the baby.
Hmm. It's like trying to have all the freedom without any barriers.
That's right.
It doesn't really happen in the real world. Okay, so that's number one.
Hmm.
What are the other 2 points?
Well, yeah, no. So it was number one is really just focus on the earliest stage, forget the other stages, and the other is make a choice. So the other two are either go this qualitative way or this
Ah,
quantitative way.
yeah, got it. So after you did your first bootstrap blue sky, when you felt like what, you've been a serial entrepreneur how many times now? Five?
Yeah, five.
Yes. What was it like the other time?
Yeah. So
Such a telling chuckle.
yeah. Yeah. So I guess what I'll start with is that after I got some liquidity, right? So as a young man, I got liquidity. I was burnt out. I went traveling. I started playing on the professional poker circuit. That would be important, for later ventures, but I also started angel investing myself. And I got a taste for what that was like and how hard it is to pick winning investments at the early stage. And so I'm not minimizing how difficult the venture capitalist's job is. I just have a different approach to, okay, how do you solve for that?
Do you solve for that? What is
Yeah.
like, so this gets into your disruption, right? Because you look at, okay, this is how it should be. Then you're running up against how it is, right?
Yeah.
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 How
That's a great, yeah.
how do you solve for that? Because I can see them. They need to de-risk, of course.
So the biggest structural problem with venture capital, whether you're doing it formally as a VC or whether you're doing it as an angel investor individual, is there's no liquidity. There's no way for an investor or a founder or any early stakeholder employee of the company, if they have stock in a company and they want to sell it for whatever reason, maybe they need to buy a house or, they have medical bills or it's time for them to leave the company and they're not going to have any more direct influence. And so they want to get out of their position. In venture capital and in early stage and in startups, you're looking at 10 years or more before
Hmm.
anybody gets liquidity. And that's just a lifetime. It's untenable. It doesn't work. It doesn't work for anybody. And it's actually one of the main reasons why VCs structure things in the what I call the perverse incentive way that they do is because they're trying to solve for this paradox of I have this incredibly high yielding asset class. There's no liquidity for 10 years, and 9 out of 10 of the companies that I invest in are going to go broke, can be complete zeros. And
I mean, that doesn't even sound like a fun job
it doesn't sound like
at all. It doesn't. It doesn't.
doesn't sound like that fun as a founder either, because
No,
you're only
I
investing in
know.
one
Either
thing,
or. Both
right?
sides. Yes.
Yeah. So to me, the magic unlock is liquidity. And where is there liquidity? Well, the public markets, right, is one area where there's liquidity. And somebody reminded me, one of the companies that I co-founded later was called crowdfunder.com, and that was equity crowdfunding. And
Yeah.
somebody reminded me, equity crowdfunding has been around for hundreds of years. It's called the stock market. That's the stock market was meant for capital formation for getting new ventures off the ground, and you had liquid stock. Okay,
I love
brilliant
that
idea.
history lesson. Just
Yeah,
a reminder.
yeah,
Yeah.
right. The Great Depression and the stock market crash of 1929 that unfortunately put the kibosh on the stock market being used as equity crowdfunding
Mm.
because truly there were a lot of scammers and stock jobbers and you can all read the history books, but that was why the regulations came in for good reason, but unfortunately baby and bathwater. Okay, so number one, liquidity, public stock market. Number two, now cryptocurrency,
Yeah.
right? And so I'll just kind of leave it there. You can take it where you want to go.
Well, I mean, there's so much. Yes. Okay, great. So you have public market, right? And you have cryptocurrency. There's so much misunderstandings, fixed ideas, false data on the crypto market. Like, but that's the area that you chose to go. Yeah.
Yeah.
So debunk some of the myths.
Well, I'll just say that, I view a startup, right? A company, a venture using its equity and capital from outside investors as fundamentally the same thing as an application in crypto or blockchain using a crypto token for both the equity in the project and the capital used to make it go. So to me, crypto enabled commerce, crypto enabled ventures and businesses is the next logical evolution of startups meet public companies meet growing ventures. I think that the future of venture capital is through decentralized technologies and Web3 and crypto and blockchain. And so to me that they're the one and the same.
So interesting. Well, that's what you guys are doing at the crypto company, right?
Exactly. That's
Yeah.
why
Okay.
we
So
started.
tell us a bit more about that.
Yeah. So when we started early. We started in 2017 before the world had heard about Bitcoin, and we were enthusiasts. It was me and three other founders. We were personally invested in Bitcoin and other altcoins, as they were called, cryptocurrencies, and we were just excited by the innovation that was happening. There were decentralized versions of Amazon AWS. There were decentralized versions of social networks. There were decentralized versions of Uber and Airbnb. Entrepreneurs were building their startups on the blockchain. And to us, that was extremely exciting. We felt that, a true renaissance was in the offing right there. And so we jumped in and we said, look, the world is not quite ready to invest in this area themselves directly. And there's a lot of education that has to happen. There's a lot of, I would say, maturation of the technology and the security, et cetera, that needed to happen. We wanted to be the bridge.
Mm-hmm.
So we started not as a private company, but as a public company. And I think we were probably the very first public company to accept cryptocurrency uh, as payment for our stock, to invest in the company. I think we were the very first public company to have a digital asset treasury, although we didn't call it that. We just called it our portfolio of crypto that we were trading on our balance sheet as a public company. Where I think we were the very first public company to have audited financials with a crypto portfolio. So we did a lot of firsts.
Not a
And
first,
yeah.
Mr. First.
I guess, yeah,
Yeah.
yeah, that's true. So, and we saw what was coming. We just didn't realize it was going to take almost another 10 years.
The 10 years you wanted to get away from
Yeah.
is the 10 years. But do you think that had a lot to do? Well, you mentioned three things: the education, the maturation of the technology, and the security. I think the maturation of the technology definitely has come forward. Security has come forward. I still think there's a huge credibility gap. There's a lot of education still needed, don't you?
I mean, you must be right. I'm in my own bubble in my own world, but you're for sure right. I think the name crypto, it scares people, right? But really this is, I mean, back to my computer science geek days, when a friend of mine told me about the Satoshi white paper. That was the original protocol paper. It's like a 9-page document that
Yeah.
described this peer-to-peer permissionless money. So he told me about it in 2010, and it took me a while to get my head around what he was talking about, because it was an inversion of everything I'd learned about computer science in college. It was really inefficient way to do computation and financial transactions.
Mm.
And when I was asking him, so wait, I don't understand. You're doing decentralized computing. I get this idea. You have this decentralized ledger where nobody is in control. There's no middleman, et cetera. But it takes an exponential amount of computing power to write every next block.
Yeah.
What's the purpose of that? That seems
It's a bit of
really
a paradox.
wasteful, really wasteful. It takes so much energy, an exponential amount of energy. He said, yeah, that's the point. That's how you know it's secure. And a light bulb went off, and I was like, wait a second. I see. This is a different way of doing computation at scale. And the incentives are aligned for everybody in the ecosystem to be effectively playing this game of cracking encryption, hence crypto, cracking encryption problems. Because what that does is that secures the network, that creates the value, and that creates the base layer of value, the base layer of truth, consensus mechanisms, consensus truth. This is brilliant, I thought. And so I saw this as this would be I would say, the future of base layer money and finance. But what I didn't, nobody had saw at that time because it hadn't been invented as what happens when new protocols come along that are computationally less expensive. They're still as secure, but allow you to do arbitrary computations. So Ethereum, for instance, a
Mm-hmm.
computer on the blockchain, smart contracts, it's just a computer, basically, a computer program. And then a huge proliferation, hundreds, thousands of new blockchains, each solving, a different part of the puzzle of what you need to do to create decentralized web technology. That's why it's called Web 3. Web
Right.
1 was the Internet of Information,
Yeah.
right? We connected the world's information. Web 2, so the social web, connecting people, right? And then Web 3, connecting value, the Internet of Value. So I'm not sure where, I lost the train
Where
of
we're
thought.
going with
Help me
this.
land the train, but yeah, to me,
Yeah,
it's very
well,
exciting.
we were definitely talking about the education gap or the education factor, right? And you mentioned you were in a bubble, and I totally get that. And then you're explaining this. Like, let's go back to crypto company. Tell me some of the things that you guys have been able to accomplish since 2017 and how you're really helping fulfill the mission that you started off with.
Yeah, well, this is maybe it's a coincidence or maybe not. It's a cosmic, yeah, it's a very auspicious day because just this morning we announced publicly that we acquired the technology for a new layer one blockchain and cryptocurrency called Frame. And I couldn't be more excited because the use case for this is the unification layer for all the other cryptocurrencies. So what's happened since we got into it early is I mentioned this proliferation of lots of different blockchains, each with its own different utility.
Yeah.
And that's great. We like that diverse landscape and use cases. But unfortunately, that has fragmented the value of the entire ecosystem into these silos, right? And so imagine that, if social networks have also done that, right? So originally there was just one social network that ruled them all. And then, so you had, Facebook, I guess, consolidated all the social networking. And then you had things like Instagram and TikTok and Snap and it's good because one size doesn't fit all and different audiences for different social networks. Same thing in the crypto universe. However, you want to be able to cross-pollinate. You want to be able to interoperate between all the different blockchains. And you want to have, importantly, liquidity,
Yeah.
financial liquidity between them. Because if this is the Internet of Value, imagine that you have, I'll use another analogy, back before the interstate highway system, you had local economies, right, in every major hub, and pretty much they were silos. You could do business locally, but to really do commerce, interstate commerce, it required the interstate highway system. And so that's what, the crypto company's Frame blockchain is meant to address. It's the unified liquidity layer and interoperability layer that speaks to each of the other blockchains and cryptos and allows them to interoperate. You don't have to be able to talk from one crypto to the next. That's what our system does.
Wow, what a great analogy. Congratulations on what
Thank
you've
you.
done.
Yeah.
Yes, yeah, that was a great way to explain it. So what are your challenges?
I think education really is, and education and communication really is our number one challenge. I think that the technical hurdles are not large anymore. I think that there is an explosion of demand happening natively, but also because of AI. Already agents are transacting billions of dollars on the blockchain using crypto. Why? Because they don't have bank accounts, right? And nobody can identify them. You can't they just don't work in the
Right.
traditional financial system. Don't have bank accounts, don't have credit cards, they can't do wire transfers, but they can work on crypto.
Mm-hmm.
And so that's where they're going to, and that's, whether they're, semi-autonomous or whether it's a human having their agent go out and do things on the blockchain that require money. There's an exponential growth, we believe, coming. And so also more and more financial institutions, all the major players, all the governments realize that as fiat currencies are inflated and debased, if you're an investor, a big financial investor, or you're an everyday person, you really want a store of value. You want a place where no governments can come in and inflate your currency. They
Hmm.
can't. And so, we believe that the explosive growth of crypto commerce is coming.
Yeah.
And
Well, I
so,
think
yeah.
with that, you're right about the education. With that, I think you have a duty to educate.
Yeah. So one of the things that we did several years ago is we acquired the Blockchain Training Alliance, whose mission is education and educates, some of the biggest institutions, companies, and government agencies in the world. So we agree with you. Education is a big part of it.
Yeah, for sure. And really like being able to do that also in, I call it the court of public opinion, right? Because now you have your average Joes learning more about this. And it's great if you can educate about the future, the market, and the pitfalls, right?
Yeah, agreed.
Yeah, for sure. Okay, so what are plans for crypto in the future? Where are you guys going?
Well, I mean, really now it's we're very, very focused on, the launch of the frame cryptocurrency and blockchain, which we aim to do that later this year. So we're finishing the rollout of that. And I think a big part of it is just getting the word out, educating. You guys do a great job of that. So thank you
Thank
for having
you.
me on.
Yes, you're
Um,
welcome.
you know, people can find me and find us on the web on thecryptocompany.com.
Great. It was my next question. Yes.
Yeah.
Yeah.
So we'd love to hear from folks who believe in the mission and want to help.
Awesome. Fantastic. Now, what do you do in your copious free time? Do you still play poker?
Yes, I'm laughing. So, yes, no, I'm no longer playing poker professionally. I do play recreational, maybe once a month with friends or charity tournaments and whatnot. But really, my kids. So my wife and three boys, ages 7, 10, and 13, are the lights of my life, and they're at such fun ages. So, in my copious free time, I'm a father and a husband and a friend.
That's fantastic. I love that. Okay, well, congratulations on everything that you're doing. I think what you're doing is great and how you're helping startups and founders. I really hope that you guys achieve your mission to do
Thank you.
more. Yes,
Yeah.
absolutely.
It's gonna take a lot of us, right?
Yeah.
And so, I would say to founders, now is the very best time to really start not only investing in AI in terms of infrastructure, but to start thinking about doing business on the blockchain, because those two forces are converging in I would say, a doubly exponential way. And
Mhm.
the way to not get swept away is to get in front of the wave.
Beautiful. I was going to ask you food for thought, and you just gave it to us right there. Mic drop moment. So,
Cool.
so before we end off, we're talking about education and so forth. Where do you think is the best source of information where people can learn more about what you just said?
Well, I mean, for me, the go-to is Claude AI. If I want to learn about anything, I just go to my AI these days. Like I said, you can come to our website if you want to know what we're up to in the world of blockchain, crypto, Web3, thecryptocompany.com. And yeah.
Fantastic. Okay, Rafe, this has been a ton of fun. I know people are going to have questions and reach out to you. That's a wrap, everyone. If you learned something today, I know you did. Go tell someone about this podcast and tell people to go disrupt their markets with a tidbit from this show. Thanks for listening to Disruption Interruption, where we transform lives, we change consumer behavior, we definitely alter economics, and we never accept the status quo. Ciao for now.
Because we live in a highly litigious society, with America being one of the top litigious countries in the world, here's our legal disclaimer. This information is not intended to be a substitute for professional public relations or legal advice. Do not disregard seeking professional, legal, healthcare, or financial advice, or delay seeking professional PR or legal advice because of something you have heard here. Contact an attorney to obtain advice on any particular legal situation or problem. Use of this podcast or our website or any of its social media or email links do not create an agency-client relationship between Johto PR and the user.